Today, everyone, something a little bit different. We're going to be talking about your small business deal and a loan that you might get from the perspective of the bank. Stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right, everybody. I talk with a lot of people who are interested in buying a business, and often the conversational topic of getting a loan comes up. And what's interesting is that people will, ask me for secret insights or, best ways to present a deal or whatever, in order to somehow, unlock the banker's vault, that there's a certain way to present something or to do something in a way that will allow people to access money from a bank. And so, you know, people will often see the banker as some kind of a gatekeeper or what have you, and they're looking for the way to kind of get past that person to get to the riches hidden away in the safe. And that's not really how it works. And so today what I wanted to do is I wanted to talk about your business deal and the loan that you might get and think about how the bank thinks about it and think about how the bank thinks about it over the course of the time that you're going to have this loan and some of the worries, concerns, and fears that lenders and bankers have about what could happen in your deal over the course of time. And we're going to talk also a little bit about the difference between the banker that you might speak to and some other people at the bank that you likely will not be able to meet, who are the underwriters. And so we're going to talk a little bit about that as well. Now, the content of today's video largely comes from a document that I created last year for our appraisal and consulting business. It's called Eroding Assurances: How the Six Stages of Small Business Failure May Jeopardize Lender and Landlord Security. And if you're interested in a copy of that, you can head over to the Education Center, which is over at businessandassetvalues.com. Go to the FAQ tab. I'll also put a link to that down in the show description as well. But at the bottom of that FAQ page, there is a place with some special documents, and you can get the Eroding Assurances document there if you're interested in reading more. So let's think about this. Let's talk about the bank and what the bank does, because a lot of the times, when I ask entrepreneurs, what is the bank doing when they're talking with you about making a loan, people will often say that the bank is checking boxes on a checklist of some kind. They have some kind of criteria. If you're in the United States, you might be very focused on like SBA loan criteria, for example, and the different things that the SBA wants in order to give a guarantee on the loan. And a lot of the times people are thinking about it as this, sort of dance of checking off all the boxes. Am I going to get this, sort of criteria satisfied? I'm going to get this other criteria satisfied. And so it's almost kind of like a game. When we look at it from the lender's point of view, I will, ask you this question. Do you think that the bank is investing in your business? Right? And the answer to that question is almost always certainly no. They're not investing in your business. If they were investing in your business, they would be buying some shares. They would be equity partners with you. That would be an investment. If I invested in your business, I'd probably buy some shares in your business, right? So what then is the bank trying to do when they're looking at your application and they're looking at the deal that you're working on? What is it that they're trying to do? Well, I spent a moment here, and I actually wrote it out, and I said, what they're trying to do is they're trying to create risk managed cash flows that earn them a return on their and their depositors' capital. Because the money that the bank gets to put into your deal, they're either getting it from their depositors, which means that they are borrowing money from depositors. That's what a bank deposit is. It's a loan to a bank. Or if it's a non-deposit taking bank, and there are some of those out there, a lot of them, then they in turn may be leveraging some other asset or facility. So they could be borrowing from another bank, a bigger bank probably, and then they've got a business model around making loans to businesses, right? So they're trying to create a cash flow of payments that's going to come into them every month, where they're going to collect money and earn interest, and their goal is to get every last payment and have no hiccups, delays, problems, or anything happen that could go wrong, right? And so, in order for the bank to be able to control that risk, they have to figure out what way do we have to make sure that we're going to get all of this money. And so, I've got it broken down here into a couple of different what I call layers of assurance. So these are the different things that the bank is going to look at to make sure that every payment is going to be made. And uh, the first one is the cash flow of the business. So the very first thing that the bank is going to look at is they're going to say, do we believe that this business, and it could be a startup, it could be acquiring a business, which is what we most often talk about on this channel. They're going to say, do we believe this business can afford to make the debt service payments? And so this is where you get into a conversation about different rules having requirements with respect to things like debt service coverage ratio, and balance sheet ratios and all that other kind of stuff, right? This is all about analyzing the business. And so, in addition to seeing how the business has performed in the past, they're also going to look at whether they think you're qualified to run the business, if you've got the right skills, et cetera. Um, they're also going to consider things like the stability of the cash flows over time. So if it's been an even Steven sort of growing at inflation kind of revenue business with profits that look the same, they're probably going to have a lot more confidence than if it's been jumping all over the place, for example. They're going to look at maybe who the customer base is, who uses, these services. And this is where things like customer concentration problems can cause a deal to go sideways. And they're going to look at the business model. They're going to say, do we like how this company operates? Do we think that this is a risky business model or not, et cetera? Some other things that they could look at that may not impact, that might not stem from your particular deal, but could certainly have an impact on whether or not they believe in the cash flow of the business. So things like the industry. I've had clients before who have had really great deals put together that were going to cash flow in a fantastic way. And they've spoken to a banker who says, yeah, that looks like a really great deal, but we are overexposed to your industry. And so we're not writing any deals in your industry right now, right? And that's got nothing to do with you. It's they've got some kind of risk management thing going on within them, their own, you know, viewpoint, because again, they're looking at these loans as cash flows, and they're trying to protect their interests. And one of the ways that anyone, protects their investments or in cash flows, for example, would be to make sure you're diversified across many different industries. So if they've over invested in one area, or they have too many loans in one industry, they might say, hey, we don't want any more right now, we want to do other things, so we have sort of a balanced portfolio. The economy in general could be something that they're looking at. So if the business is offering a product or service that's more of a discretionary kind of thing, they might decide that they don't feel that the economy is strong enough that if people have to start cutting back on spending, that this business might bear an abnormal, amount of that cutback, right? It's more susceptible to people deciding not to spend money, or it could be a specific market. So, in a small town with one big employer, for example, it might be harder to get a bank loan because the bank sees the risk that if the big employer were to close, that is going to have ramifications for everyone else around it. So that's the first level of assurance, let's call it, the actual cash flow from the business. What are they going to look at next? Well, the next thing they're going to look at is you, right? If your business somehow cannot make the debt service payment, then how will they get the money? It's going to be from you. So this is where we look at, your own personal net worth statement, for example. Do you have other resources? Do you have other money? if you are a multimillionaire and then you want to borrow 100 grand from the bank, there's a good chance that they'll say, well, if this thing doesn't work, he's got the money to pay us, so let's approve him, right? Your own employability may be considered in this. I've spoken with bankers before who say they do look quite closely at the individual and the individual's employment history, even if they're buying a business to become the owner operator, because they know, for example, if they make you a loan and the payment on the loan is, I don't know, $1,000 a month or $2,000 a month or something like that, and the business fails, they know that there are people out there who will shut down the business, go get a job, and still make the bank payments, right? And so that's something they look at. They're like, this person's ability to earn money, they could choose to pay us off instead of going through some kind of default, bankruptcy, et cetera. And and you know, this is a little bit of a foreshadowing into what I'm going to get into next. But you know, I once had a banker say to me that his best customers would starve their own children before missing a payment to him. And it's true. There are people out there who are going to look at that commitment to make that payment above all else. And those are the kinds of people that the bank wants to lend to, right? Because ultimately the bank wants their money. Third level of assurance: collateral. So, is there something in the business that can be liquidated, sold, etc., to get money to pay off any outstanding loan if something goes wrong in the deal? So, this is where things like machinery, inventory, fixtures, anything of tangible value that's going to have some kind of value if the business is no longer operating, that can be sold or auctioned off. So, that's going to be of concern to many lenders, and it depends what kind of lender it is. So a leasing company, for example, is very concerned about the collateral in their deal. A bank making a conventional loan with no government guarantees, for example, they're going to be very concerned about what the money has gone into as far as equipment, machinery, etc. Um, Even if there's going to be some kind of guarantee, which we're going to get to next, the guarantors often require the lenders to consider the collateral and the personal guarantee because they want the guarantee to kind of be the last thing, which is why it's the last on my list. Level four, assurance number four, third party guarantees. So we often think about government guarantee programs. So in the United States, this is the SBA program. In Canada, it's the CSBFL program. Basically, the government says if something goes wrong, we are going to backstop a certain percentage of the outstanding balance, 90%, for example. And so that gives great comfort to the lender because they realize, hey, if the business fails and the person doesn't come good with the money on their own and there's not enough collateral for us to sell, we can then go to the government entity and ask for 90% of what's left, and we can cover ourselves off in that way. There are other guarantees out there, though. There's not just government guarantees. So for example, you could have a co-signer on your loan. I've met many people who bought businesses and their spouse has co-signed the business loan. And that's another example of a third party guarantee where the lender sees another person with another income stream. And this gives the bank assurance that there's another pathway to recovering the money if something goes wrong. You can also have related companies guarantee the notes. I've had deals where that has happened too, where somebody owns more than one business and the businesses are successful and they want to borrow money for a new business or an acquisition. And the bank will actually ask for one of the other companies to guarantee the note as well or co-sign the loan, knowing that that other company is a successful, profitable business. Maybe they already made loans to that company; they know it very well, and so they've asked for that as a guarantee as well. That can happen. So, what then can go wrong? So we get the loan, the banker's happy because they've got all these four levels of assurance and they've got all the paperwork. Now, what is their fear? Their fear is that they're not going to collect all the money. So I have on here an image called the 6 stages of small business default. And we're going to go through these because I want to make it clear that bankers' fears are really grounded in reality. Uh, Listen, like they banks institutionally have gone through all kinds of small businesses defaulting on their loans, and they learn from this, and they create policies and procedures that all of their employees have to follow because they're trying to learn from their institutional experiences, and they're trying to use those experiences to help prevent other losses, right? Does that make sense? Of course it does. So the first stage of small business failure is that there's some kind of problem in the business. So sales drop, costs go up, there's reduced profitability, et cetera. So what then happens, right? Does the business owner, miss their payment? No, they don't, right? They still make their payment. What ends up happening is that, if there's cash reserves in the business, the owner will use that money to cover their expenses and stuff. But what does that then mean for the business? It means that the balance sheet of the business is weakening because their cash position starts to go down, right? So this is like the first stage of the business failing. It's just it becomes weaker. And at this stage, most business owners are saying things like, "Oh, we have this little bump in the road. We're going to recover. Sales are down this month. I'm sure next month it'll be better. We have a lot of opportunities in the pipeline, et cetera, et cetera." But the point I'm trying to make is the first step is a small one, and it's simply that the business becomes weaker, right? Other things can also happen too, like more slow paying suppliers more slowly. So your accounts payable starts to get bigger, um, and maybe you're having less success collecting from your customers. So your cash isn't doing as well because your accounts receivable are growing. These are all, again, functions of a business getting into some degree of stress. The next stage is that the business owner starts looking for short-term fixes because usually still at this stage, the business owner is telling themselves things are going to get better. I can see the light at the end of the tunnel. It's just because of the election, because of this news, because of that thing that happened, the trade tariff, whatever, right? So the business owner is still very optimistic, and they realize I'm going to run out of cash, and I can't afford to not pay my employees. I can't afford to have my landlord after me. I can't afford to have my banker after me. So what do? They go for short-term fixes. So a short-term fix could be something like uh, borrowing money, using a credit card to get a cash advance on that. The owner could stop taking a salary, for example. What does that then do? It means that the owner now is living off of their savings or getting into more personal debt on their own, shrinking the strength of their personal balance sheet, which affects that second sort of level of assurance, right? The personal guarantee. So, in an effort to try to help the business be more successful, this can also extend to things like, merchant cash advances or taking high interest loans or some of these new fintech offerings that are out there where people will take money to try to get cash to cover short term things that have to be paid. And they end up really forfeiting their future because they've got these huge interest costs associated with that borrowing. So, short term fixes, I call it the second stage of a small business failure. The third stage, I call it liquidation begins. So it's not the bank liquidating the business, it's the owner liquidating their own business. So this is when things start to be sold or reduced in order to try to raise cash. So if your business has inventory, what you're doing here is you're selling down inventory and not replacing it. Or you're finding the slower moving inventory and you're selling it even at a loss just to get cash. I ran into this once back in my old Yellow Pages days. I called on a guy who owned a used car lot, and I asked him how things were going. He said, "Well, it's not a very good morning. We have a whole bunch of bills due, and we don't have any money, so we're trying to figure out which of our cars we're going to send to auction, and which is where they buy the cars. So they are now going to send cars to auction to get cash. And it means that they would lose money on every one of those cars because they have to pay auction fees, et cetera. And they may not get the same amount of money that they paid for those cars. And those cars are no longer available on the lot to be sold to earn profit. Right. So what they were doing is they were liquidating part of their inventory to raise cash. This is what I'm talking about in liquidation begins. You can also see, in businesses that are in this state, things that are not being repaired that should be repaired. This is when businesses start to look a little dog-eared, like they're not doing, maintenance properly. They're not keeping up on things, and basically, it's they're trying to squeeze out cash as much as they can to cover these shortfalls. And the fourth stage of small business failure is when a payment is missed. Now, most of the time, this doesn't create a big problem until it's been 30 days that the payment has been missed. Um, if you don't believe me, just try it. Like miss a payment of some kind. You might get a phone call or an email from your lender. And then if you make that payment, they go away, right? It's usually only a problem once your payment is 30 days late. And this is like what I'm explaining to you here. This is why I take all of the small business loan default rate statistics with a huge grain of salt. When people put up statistics saying, SBA loan rate defaults are this super tiny, minuscule amount, therefore small businesses are successful and profitable. I'm like, no, that doesn't mean that at all. It just means that people haven't really gotten down to this point, that there's still have other options before missing a payment. And if people miss a payment and then make it up a couple weeks later, they're probably not counted in the statistics yet. But a real missed payment where you miss the payment to the bank and you don't make it within 30 days, and now somebody's got a thing on their desk saying, hey, this business person has missed a payment. We got to go and check things out and see what's going on. Well, at this point, like let me look at the 6 stages of small business default. At this point, we've already gone through like four of these steps, and we're now entering what I call the visible stages, which is where the lender can actually see that there's a problem for the first time, even after all this stuff has already happened, right? So you miss a payment, the business's balance sheet has shrunk. Some collateral may be gone now. They might have sold some equipment. The inventory certainly has shrunk if there's a large inventory in the business. The business owner's personal balance sheet has probably weakened because they probably put money into the business that has now been lost, or they haven't been paying themselves, which means that they personally are now in a weaker financial position. So everything has eroded, right? Which is why I called the thing eroding assurances, um, which you can find with the link down below. So um, so they missed a payment. Now the bank has to take action, right? Now the bank has to actually start calling them. They've got to say, hey, we need you to submit more documentation. We need to figure out what's going on. And at this point, the personal guarantee often is worthless. So, I've mentioned on this channel before that if a bank is asking you for a personal guarantee on a small business loan, that you should probably just give it. And people always freak out. They're like, I don't want to personally guarantee it. I'm like, it's not going to matter. But by the time a lender comes and wants to take you for all your worth and your personal guarantee is probably not going to be worth anything at that point. And this is what I'm getting at here. Like you are going to want to try to make the business succeed because you've put the down payment into the business, and you're committed to making sure that was a successful investment, and you're fighting, fighting, fighting every day to get this business to work. By the time you reach this point, like your own money has probably been lost in this endeavor, right? So now the bank is coming along and they're saying, okay, you've missed payments. Now we need to figure out what we're going to do. And see, I have actually a lot of experience with this because we do certified machinery and equipment appraisals, and we sometimes hear from bankers or their lawyers at this point where they're saying, "Oh, we have to figure out if we're going to foreclose on this person. We now need to figure out what the stuff is worth." And often the lenders are way too late, right? Um, so then what are they going to do? Then they have to make a decision. So if they know what the collateral is worth, or if they send someone like an appraiser to go look at the equipment and they get a report back saying what the equipment is worth, they then have to figure out what they're going to do. Are we going to actually act on this? Are we going to try to seize the collateral, send it for auction, or what have you? You know, who knows? The final outcome, of course, is that the business is closed in some way and it's liquidated in some fashion. And that can be as simple as somebody else buys the assets for pennies on the dollar. Maybe the business stops paying its rent if it's in a rented place, and the landlord seizes what's there as far as guaranteeing their own lease. And so they go and they lease the place to another operator. You know, I often talk about restaurants selling on what's called a a redevelopment value. So there's a lot of restaurateurs out there who are able to lease a space that basically already had a restaurant built in it because the previous tenant, couldn't pay the rent and ended up closing. And, there could have been furniture in there, restaurant equipment in there, the bar in there, all the plumbing, the venting, all that kind of stuff that costs a lot of money was already done for them, because the landlord, changed the locks on someone. So this is how, this goes down, and this is why lenders are so concerned up front about getting this stuff right. And the best lenders actually take the time to maintain visibility into the business as the years go by, because they're trying to foresee these problems. So some of the things that a smart lender would do, for example, is have requirements for regular reporting. They might want, quarterly, annual reports, or tax returns. A lender asking for tax returns, in my opinion, is already behind the ball, because you're so far away from what the things actually happening, that if there is a problem revealed in the tax returns, you're probably already several steps along the failure path. You know, and this is why banks who have very big loans out, like if you borrow $20 million from a bank, you're going to have somebody who is like on your file, and they're going to be looking at you all the time, because there's a lot more risk there. If you're borrowing 100 grand from a bank, they've got to go to some kind of automated process, just because they can't afford the cost of having somebody observing this. Now, with the introduction of AI tools, this could be changing, let me tell you, in a big way, because it's going to be far easier for banks to absorb information about what's going on in your business. One of the reasons why a lot of banks will require that their borrowers do their day to day banking with them is because they want to be able to see the accounts, because they can derive a ton of information about what's going on in your business from looking at the checking and savings accounts that you might have for the business. A smart lender is going to ask for proof of an owner's salary or draw. So, a good lender is going to want to make sure that the business owner is able to support themselves through some kind of earnings from the business. Because again, if the owner isn't taking anything from the business, that's a sign of a problem. The business isn't earning enough money to support its owner. That means the personal guarantee is eroding. It also means that not taking the salary is masking problems in the business. Annual credit reports or net worth statements from the business owner is something that a lot of lenders will do too. A lot of them will just do soft hits on a credit report on a regular basis, just to see if other credit facilities are shooting up. If they notice that all of a sudden you're borrowing on every other credit facility that you have, that's a red flag for them that something could be wrong in the business. If there's a lot of equipment or inventory or something like that in the business, then a prudent lender might require some kind of regular reporting or maintenance or update, et cetera, on that equipment. And the people who are really good at this are people like leasing companies. So they might require, for example, that you submit proof of things like maintenance, oil changes, et cetera, on like trucks, stuff like that. And it's not so much that they are wanting to make sure that you maintain the truck. But whenever a mechanic does work on a vehicle, one of the things that's always noted usually is the odometer reading, right? Or if it's another piece of equipment like the hours. And so they can like keep track of these basic bits of information and get an idea of what the value of the equipment might be doing. They'll have a computer model for that. More general lenders like banks, they don't do this as well, and it's usually because they're relying more heavily on those other levels of assurance. They know that if they lend money to a restaurant or something and they try to liquidate it, they're gonna get pennies on the dollar. Um, so if there's, a lot of gear, what we actually recommend to lenders as for our clients is that they actually get an appraisal in the beginning, which is very common if equipment is being used as collateral for an acquisition financing loan. We say get the appraisal at the beginning, and then periodically through the life of the loan, you can get updates on that and updates on the assets. One of the fun things that often happens is that a person will buy a business and there's a bunch of equipment in the business, and the bank will be very studious about recording the serial numbers, model, make, et cetera, of all the equipment. And if there's an appraisal, they'll have all that together with the values. And then over the course of the next 4, 5, 6 years, what happens? Well, equipment breaks down, it gets sold, it gets scrapped, new stuff is bought, and the loan agreement says that every time this happens, the bank is supposed to be updated. But do you think that really happens? No, doesn't happen at all. So we've worked for banks before, for instance, that say, we're redoing the financing on this business. We made them a loan 6 years ago. This is what we have for an asset list, but we realize it may not be real or accurate now. And so we'll go into the business and I'll be asking people like, hey, this forklift, where's this? And they'll be like, oh, we got rid of that years ago, or it's in the back on blocks because it doesn't work anymore. We bought this other one, right? And so it's just a matter of updating the asset list and recording what is actually in the business so that the security registrations can be updated. And so that's sort of a regular process that should be undertaken by a lender that's trying to make sure that the collateral is good um, uh, over the course of the loan, especially if you're going to be redoing the financing. As long as that loan balance is going down all the time, the risk that the lender is taking is declining as the loan balance goes down, right? But if they're going to redo the financing or extend it or something like that, then it's worthwhile to go and take a look at the collateral that might be in there. Um, every lender is going to require a lot of paperwork. Not every lender is going to have a fantastic degree of visibility into the business. And from a borrower's point of view, if you're dealing with a lender, I made this video today so you can kind of have an idea of why they're asking for the stuff that they're asking for and why they're putting in the terms and conditions that they're putting, why they want you to report certain things. It's because they're trying to manage this risk and they're trying to figure out, you know, which of our loans are going to go bad or which loans do we have to pay attention to. They have a certain algorithm or a plan that where they know that a certain percentage of their loans are probably going to be great. Others are going to have difficulty. Some others are going to default. Some other ones, they're going to have to sue people or whatever. And they're trying to manage this risk all the time. And that's really what their business is. Their business is about managing the risk that they're taking by deploying money. A lot of times it's not their money, it's their depositors' money. And they have to try to keep that money safe because otherwise they're out of business, right? That is their business, is basically managing risk. And so again, if you want to learn more about this stuff, you can head over to businessandassetvalues.com. And if you go to the FAQ page at the very bottom, there's a whole array of special reports depending on who you are. If you're an entrepreneur or a lender, or even somebody that is an advisor or consultant or business broker, there's stuff in there about appraisals and business valuations and stuff like that. Again, this is from the asset and appraisal side of our business that I don't often talk about here on the channel. But with that, I'll say thank you very much. I hope that you've enjoyed today's video and it's given you something to think about. And if you ever think that we could be of help to you, whether you're a lender or a business owner or a potential business buyer or what have you, don't be afraid to reach out. That's what we're here for. You can always reach us at any one of our various websites. But businessandassetvalues.com has our email and everything on it as well. And with that, I'll say see you later. And we'll talk to you next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.